All right, let's talk about something that you probably never think about, but that literally keeps the global financial system from falling apart. Today, we're pulling back the curtain on a set of rules called the Basel Accords. And believe me, understanding them is key to understanding how the world keeps your money safe.
So, we all know the world is connected, right? But have you ever really stopped to think about what actually stops a big bank failing in, say, Germany from causing a domino effect that could wipe out your savings account right here? Well, the answer isn't just luck. It's a fascinating and honestly pretty remarkable story of global teamwork.
You see, after a couple of pretty nasty financial scares, it became painfully obvious that one bank's problem could become everyone's problem, and fast. This led to a pretty radical idea. What if we created a single global rulebook? You know, a common set of standards to make sure all the big international banks were playing the same safe game.
And the group that took on this massive job? The Basel Committee on Banking Supervision, or BCBS for short. They're named after the city they're based in, Basel, Switzerland. You can kind of think of them as the referees of global banking. They're the ones setting the rules of play to make sure things stay fair and nobody makes a move that brings the whole stadium down. Okay, but here's the really interesting part. The Basel Committee can't actually make laws. They don't have that power. What they do is issue recommendations, basically a set of best practices. It's then up to each individual country to say, yep, that's a good idea, and actually write those rules into their own laws. It creates this whole system that runs on a shared promise to keep things stable.
So, to really get how this all works, we've got to go back to the beginning. The very first attempt, the first Basel Accord. It zoomed in on one core idea that would change everything: how much of its own money a bank needs to have on hand. In other words, a bank's capital.
And the best way to think about bank capital is to picture your car's shock absorbers, right? Their job is to soak up the bumps and potholes so you have a smooth ride. Well, a bank's capital is its financial shock absorber. It's a safety cushion of the bank's own money, set aside specifically to absorb unexpected hits and losses so the whole thing doesn't just break.
So, flash back to 1988. This is when the Basel Committee makes its first huge move. They release what we now call Basel I. And for the very first time, it set a global standard for how big that financial shock absorber needed to be. This was, no joke, a massive moment for international finance.
But they knew a simple rule wouldn't cut it. Because not all money is at the same risk, right? A loan to a super stable government is way safer than a loan to a speculative startup. So Basel I introduced this really clever idea of risk weighting. Basically, they sorted a bank's assets by how risky they were and gave them a score. Safer stuff got a low score, riskier stuff got a high score. Simple, but brilliant. And all of that math led to one single magic number: 8%. Basel I said that after you do all that risk weighting, a bank had to hold high-quality capital equal to at least 8% of that total. For more than a decade, that 8% rule was the absolute foundation of global banking safety.
But hey, the financial world never sits still, does it? By the early 2000s, banking had gotten way more complicated, and that simple one-size-fits-all rule just wasn't cutting it anymore. It was pretty clear the rulebook needed a serious upgrade. So, in 2004, the committee came back with the sequel, Basel II, and this wasn't just a minor patch. It was a total redesign of how to think about banking regulation. It brought in a much smarter, more complete framework built on what they called the 3 pillars.
Pillar 1 was basically an update to the old capital rules, but the real game changers were the 2 new pillars. Pillar 2 said, hey, regulators, your job is to actually look over a bank's shoulder and challenge them on their risk assessments. And Pillar 3 was all about transparency, forcing banks to share more information so that investors and the public could help keep them honest. It was a much more holistic approach.
So it was a smarter, more nuanced system. It seemed great. But just a few years after it came out, the entire global financial system was about to face its biggest test since the Great Depression. A test that would prove that even this new and improved system had some serious blind spots.
I mean, just look at this timeline. It tells you everything you need to know. The 2008 global financial crisis didn't just happen out of nowhere. It blew up with Basel I and Basel II in place. That was a huge, painful wake-up call that even the sophisticated 3 pillars weren't enough.
So what exactly broke? Well, when regulators did the postmortem, they found a few key culprits. Risk management inside the big banks was, frankly, a disaster. The bonus structures were encouraging traders to take insane risks. And maybe worst of all, banks were just borrowing way too much money compared to their own capital cushions. They were running on fumes.
The world was reeling, and the response had to be powerful.
And it was. In November 2010, using all the tough lessons from the crisis, the Basel Committee rolled out Basel III. And let me tell you, this was no tweak. This was a complete overhaul designed to fix the specific things that broke in 2008.
So what did Basel III do? The biggest change was making the capital rules much, much tougher. The new minimum was 7%. But here's the key. They got really specific about the quality of that capital. At least 4.5% had to be the absolute best, most loss-absorbing kind of capital there is. And on top of that, they added a 2.5% safety buffer for rainy days.
I mean, look at this comparison. It really shows you how far we've come. Basel I was basically just worried about loans going bad. Basel III looks at the whole picture: credit risk, market risk, operational risk, and, for the very first time, liquidity risk, the danger that a bank just runs out of cash. The whole philosophy shifted from a simple number to a much tougher, smarter, and more comprehensive system.
And that's not all. Basel III also brought in the world's first-ever global rules for bank liquidity, which was a huge blind spot before. Plus, it directly took on the too-big-to-fail problem. It created tougher rules for what they call systemically important banks. You know, the giants whose collapse could take everyone else down with them. Those guys now have to have an even bigger safety cushion.
Okay, so after all that talk about pillars and buffers and risk weights, you might be thinking, what does any of this have to do with me? Well, everything. All these complicated rules create a global safety net, a net designed to protect not just the banks, but the whole economy, which includes you, me, and our financial futures.
It really all boils down to this one simple idea. This quote just nails it. The whole point from the very beginning has been to make sure that banks have enough of their own skin in the game to pay their bills and survive a big unexpected shock. It's about making sure that when a financial storm hits, and we know they always do, our banks are strong enough to ride it out.
Which brings us right back to our shock absorber, doesn't it? The entire story of the Basel Accords from I to II to III has been this constant mission to build a bigger, better, more reliable financial shock absorber for the global economy. It's all about making sure that the next time we hit a giant pothole, the ride is a whole lot smoother than it was in 2008.
And that leaves us with one final and pretty crucial question. There's no doubt the rules today are stronger than they've ever been. The system is more resilient. But we live in a world of crypto, of fintech, of risks that change at lightning speed. So, are the lessons we learned from the last crisis enough to protect us from the next one? Well, that's the big question that will define the future of finance.